Hey everyone, and welcome. Today, we're tackling a really fundamental question. How do the biggest companies on Earth actually pay for their gigantic projects? Well, the secret is in something called capital structure. You can think of it as the financial DNA of a company. Really think about that for a second. A company wants to build a huge new factory, or maybe acquire a rival. We're talking billions of dollars. Where does that kind of cash come from? It's not like they can just find it in the couch cushions. And that, right there, is the huge challenge that capital structure is designed to solve. So here's our game plan for today. We're going to start with the core problem, the funding dilemma itself. Then we'll look at the two main tools in the toolbox, debt and equity. After that, we'll dive right into a massive Nobel Prize-winning debate, put the big theories on trial, and finally, figure out what the real answer is.
Okay, first things first. What in the world are we even talking about when we use this phrase, capital structure? Let's get a really solid definition down.
In simple terms, it's just the recipe a company follows for its funding. What slice of the pie comes from borrowing money, that's debt, and what slice comes from selling off little pieces of ownership, that's equity. That specific mix, that's the company's financial blueprint.
And I've got to tell you, this is not just some boring accounting exercise. The stakes here are incredibly high. The wrong mix can literally push you towards bankruptcy. It can tie your hands, making it impossible to get cash in an emergency. It can even mean the founders lose control of the very company they built. The goal, the holy grail, is to find that perfect balance that makes the entire company as valuable as it can possibly be.
So, companies basically have two big levers they can pull when they need to raise cash: debt and equity. Let's break down what really makes them different. It all boils down to a classic trade-off. Debt is basically a loan. It's cheaper because the interest you pay on it is tax-deductible, which is a nice perk. But, and this is a big but, you have to pay it back, which adds a ton of risk. Equity, on the other hand, is like selling a slice of the pie. You don't have to pay it back, which is way safer, but you're giving up a piece of ownership and a cut of all your future profits.
And this choice, this simple trade-off, brings us to a question that has sparked endless academic battles and even won Nobel Prizes. Does the actual mix of debt and equity really change how much a company is worth? So the first camp, they're pretty clear. They say absolutely not. They argue a company's real value comes from its actual business. How good it is at making and selling stuff. How you slice up the financial pie between your lenders and your owners, they say it's completely irrelevant. The size of the pie doesn't change.
But then the other side fires right back, arguing that this is one of the most important decisions a company can make. They believe that by being smart, by using that cheaper tax-advantaged debt, you can actually make the whole pie bigger for everyone. So, who's right here? To try and figure this out, economists came up with some really powerful theories. So let's do this. Let's put these different schools of thought on trial. The foundational argument, the one that really started it all, came from two Nobel Prize winners, Franco Modigliani and Merton Miller. And their theory, simply known as the Theorem, pretty much turned the world of finance on its head. Okay, so the engine behind their original idea is this concept called arbitrage. Just imagine you have two companies that are completely identical in every way, except one is worth more just because of its debt mix. Well, smart investors would instantly see that. They'd buy the cheap company's stock and sell the expensive ones, and they'd keep doing it until, poof, the price difference was totally gone. And this is where their theory gets so interesting, because it kind of splits into two worlds. In their first paper back in 1958, they imagined this perfect world with no taxes. And in that world, they proved that the debt-equity mix is totally irrelevant. But a few years later, they added just one crucial real-world detail: taxes. See, since interest payments on debt are tax-deductible, debt creates what's called a tax shield. And with that one tiny change, their conclusion did a complete 180. Debt does add value, and suddenly the mix is very, very relevant.
Okay, so that leads us pretty naturally to the next step in the evolution of this idea, the trade-off theory. This one takes that theory with taxes and adds another dose of reality to it. The trade-off theory kind of tells a story. A company starts adding some debt, and its value starts to climb because of those tax benefits. That's great. It keeps doing this until it hits a perfect sweet spot, where the firm's value is at its absolute peak. But if it gets greedy and goes past that point, the risks of having too much debt start to outweigh the reward. So what are these risks, these costs of financial distress? Well, it's not just about paying lawyers if you go bankrupt. It's also about the really good employees getting nervous and leaving, or your suppliers starting to give you worse deals,
It's even about the fights that can break out between the owners and the lenders as things get more and more risky.
All right, our third and final theory takes a totally different route. Instead of trying to calculate some perfect mathematical balance, the pecking order theory just asks, how do managers actually behave in the real world? It's way less about spreadsheets and way more about psychology.
This theory says there's a really simple hierarchy, a pecking order. When a company needs cash, its number one go-to choice is always its own money, the profits it's already earned and saved up. Why? Because it's easy, it's cheap, and it doesn't send any weird signals to Wall Street. If that's not enough, then okay, it'll go out and get some debt. And only as a very last resort will it issue new stock, because that can make investors think, maybe management thinks the stock is overpriced right now.
So, we've looked at the debate, we've put all these big theories on trial. After all that, what is the actual answer for a real company trying to make a decision?
And the real truth? There is no single magic formula. The biggest takeaway here is that capital structure is all about making a strategic choice, a balancing act. It is not a math problem that has one right answer. It's a whole series of trade-offs that have to be tailored to each and every company's unique situation.
So how does a company find its own personal balance? Well, it depends on a bunch of stuff. A super stable company, like a power utility, can handle a ton of debt. A risky, high-growth tech startup? Probably not so much. If a founder wants to keep total control, they're going to lean towards debt over equity. And if a company has a lot of buildings and machinery it can use as collateral, getting a loan becomes way easier. But ultimately, no matter which path a company takes, it all comes back to this one single goal. The best capital structure is simply the one that makes the company's total cost of funding as low as possible. If you can minimize that cost, you automatically maximize the value of the entire company for everyone.
So I'll leave you with this question. Next time you look at a huge company, whether it's Apple or Ford or whatever your favorite is, think about how they're paying for everything. Do you think they're following a strict pecking order? Or are they trying to carefully manage that trade-off? Or maybe their success is just proof that in the end, it's all about making amazing products.